This is Nick here, and I'm about to go through the updated chart book for the Federal Reserve ahead of the meeting this week. So the Fed estimate of the normal longer run rate was unchanged at the June meeting, where they updated the summary of economic projections. So the summary of economic projections get updated quarterly at the March, June, September, and December meetings. So currently, with the Fed having hiked at the June meeting from 175 to 2%, the Fed is about 1 percentage point away from what they estimate to be the normal longer run rate. So that would be 4 more rate hikes. The market is pricing in basically about 1.5 more hikes this year and a little more than 1.5 hikes next year, which would get the Fed funds rate to around 275. So the market pricing is a little bit below where the median dots are, and I'll cover that a little bit later. One thing to note here is that there was a change in the June statement. So you can see here this quote, minutes from the Fed meeting. They record the conversation that basically, in summary, members favored the removal of the forward guidance language, stating that, quote, the federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. Members noted that although this forward guidance language had been useful for communicating the expected path of the federal funds rate during the early stages of policy normalization, this language was no longer appropriate in light of the strong state of the economy and the current expected path for policy. So basically saying that it was going to be low rates and accommodative for the foreseeable future was no longer appropriate, given that they've been in this hiking cycle now since late 2015 and have made a fair amount of progress. Then moving on to market expectations for the Fed funds rate in 1 year. So the market, this is based on Fed funds futures, and so a year from now that's pricing effective Fed funds rate of 2.63%. That in terms of inflation readings, so the inflation target is, in my view, the primary mandate for the Federal Reserve. It's the thing that they arguably have the greatest degree of control over. And you can see that we are now above the 2% target on headline PCE year over year. That's at 2.3%. Powell is more a fan of looking at the core reading. That's the light gray line there at 2.0%. The quote here from Powell, recently he says that after several years in which inflation ran below our 2% objective, the recent data are encouraging. The price index for personal consumption expenditures, that's PCE, which is an overall measure of prices paid by consumers, increased 2.3% over the 12 months ending in May. Higher oil prices, he goes on to say that number is up from 1.5% a year ago. Overall inflation increased partly because of higher oil prices, which caused a sharp rise in gasoline and other energy prices paid by consumers. Because energy prices move up and down a great deal, we also look at core inflation. Core inflation excludes energy and food prices and generally is a better indicator of future overall inflation. Core inflation was 2.0% for the 12 months ending in May, compared with 1.5% a year ago. So you can see there he's commenting that he views the core inflation reading, which is the gray line, as a better indication of future overall inflation, and that's really what the Fed is interested in. So that is technically at target, but this is as Powell says, a symmetrical target, and that means they're trying to prevent persistent deviations either above or below that 2% target. All right, then moving on to inflation expectations. So really not much to add here from last time. This has been pretty stable and pretty close to the Fed's inflation target. Just to comment on how this is calculated, it's looking at the difference between the real yield, which is estimated by looking at the basically the 10-year TIPS, which are the Treasury inflation-protected securities yield. That's the real yield. So you subtract that from the U.S. 10-year Treasury, which is the Treasury yield, which would be the nominal yield. So the nominal yield minus the real yield provides the inflation expectation. Then the unemployment rate and wage inflation. So this is kind of the Phillips Curve dynamic here. The idea is that as unemployment comes down, wage pressures should pick up. So the comment here recently from Powell, he says the unemployment rate is low and expected to fall further. Americans who want a job have a good chance of finding them. Americans who want jobs have a good chance of finding them. Moreover, wages are growing a little faster than they did a year ago. That said, they are still not rising as fast as in the years before the crisis. One explanation could be that productivity growth has been low in recent years. On a brighter note, moderate wage growth also tells us that the job market is not causing high inflation. So you can see that black line there has not picked up as much in this cycle as it has in the past two cycles, as the unemployment rate has come down. Then here's just the various unemployment rate measures. I'll let you take a look at that on the PDF if you want to look at that more closely. One thing to note is that we did have an uptick here on the last reading, up to 4.0 on the U3 rate, and that was in part on the back of an increased labor force participation rate, which is overall generally a positive thing. Powell likes to look at prime age labor force participation. He's commented that that's not back to the prior cycle. And the reason for looking at prime age labor force participation rate is that it takes out the demographic effects of basically the baby boomers retiring. Then here, Powell likes to look also at the prime age male labor force participation rate. Makes some comments about, in the quote box here, about why that might be the case, that's had a long-term decline since the late 50s. But in any case, he has commented that it's on a downward trend, but that you can see once we get into the late cycle, or it's typical in a late cycle, that you see that that participation rate trend higher. And let's see how that develops. But if it were to reach that trend line again, that might be a sign of that the economy is in the late stages of the cycle. Then Fed funds rate and financial conditions. So financial conditions continue to ease. Then on the balance sheet normalization is continuing. This is kind of working in the background on autopilot, separately from the decision that the Fed makes each meeting as to whether to raise rates. Then the Fed dot plot, so this got updated in June. You can see here the updated quote box. Powell saying that the committee's gradual approach is reflected in participants' projections for the appropriate path for the federal funds rate. The median projection for the federal funds rate is 2.4% at the end of this year, 3.1% at the end of 2019, and 3.4% at the end of 2020. So the 2018 median dot did move up, suggesting that the median expectation for this year went from 3 hikes to 4 hikes. 2 hikes have already been done, one in March and one in June. There is about a 0% chance or expectation priced in by the market for a rate hike at this August meeting this week, but the market's expecting a rate hike in September, and the market pricing suggests there's an 80% chance of a rate hike at the September meeting. All right, let me leave it there.